You just made $4 million, and you've never been more terrified in your life. Messages from people you haven't spoken to in months. Are you in this? What do you know? How big is your position? You don't answer any of them. You already know what happened. You were there for the 15 minutes that caused all of this. The P&L reads $4,127,440. You started this trade with $2 million 15 minutes ago, on a Sunday morning when the market was supposed to be closed, on a bet that oil prices were about to crash. And here is the thing that is making your hands shake right now, and it is not the $4 million. It is the question that is already forming in every headline, every trading forum, every regulatory office that is watching the same data you are watching. How did you know? You didn't know. You suspected. You saw a pattern. You followed what looked like smart money moving in a dead market on a Sunday morning when it had no reason to move. And you were right. But being right, in the wrong way, at the wrong time, in the wrong trade, can look exactly like something that has a different name, a name with handcuffs attached. Let me take you back, not to Sunday morning, further back, to the pattern you saw, the one that started this, and to the 15 minutes from the first contract to the announcement to the money in your account that you will spend the rest of this year trying to explain. This is a story about a trade, but it is also a story about how markets actually work, about who has information and who doesn't, about the line between pattern recognition and insider trading, and how thin that line is when a regulator is the one drawing it.
The Saturday before, a political ultimatum had been issued. Open the Strait of Hormuz within 48 hours or face consequences. The market reacted the way markets always react to military ultimatums, with fear. Oil was climbing. Everyone expected it to go higher. Brent crude already up 11% in the week. WTI pushing toward levels not seen in 2 years. Sunday night. Markets are closed. You are not supposed to be watching oil futures on a Sunday, but you are, because you have learned to watch what moves when it should not move, and something is moving. You check the volume. WTI crude futures, 734 contracts, normal for a Sunday morning when nothing is happening. You refresh. 1 minute later, 2,168 contracts in 1 minute on a Sunday when the market is supposed to be sleeping. That is not normal. That is not noise. That is roughly $170 million in oil bets placed in 60 seconds at a time when there should be almost no trading at all. Brent crude, the same pattern, 20 contracts, then within 3 minutes, over 1,650 contracts. Someone or several someones moving together is placing enormous bets that oil is about to fall, in a market that 24 hours earlier everyone expected to rise.
You have seen this before. January 2026. Before the arrest of Venezuela's president, someone placed a bet on a prediction market, $32,537. Within hours, that position was worth $436,000 because the news broke exactly as the bet predicted. You didn't act then. You saw the pattern and did nothing. You spent weeks thinking about what you left on the table. This time, the volume, the timing, the direction of the bets, the specific Sunday morning window before a 48-hour ultimatum expires, everything matches the pattern you didn't act on last time. You are not going to make that mistake again. Someone knew something. You don't know who. You don't know how. You don't know what they knew. You just know they knew, and you're about to follow them. You open the order ticket. $2 million. Short position. Betting oil falls. 10 seconds. Your hand is on the mouse. You have never placed a bet this size. 5 seconds. The volume spike is still there. The pattern is still there. You click. You sit back. The position is open. Nothing happens. The market is quiet. You stare at the screen. At 6:49 a.m. Eastern, a post appears on a social media platform. The words are brief. Diplomatic. Diplomatic talks. Delayed action. The kind of language that in normal times means very little, but in a market that spent a week pricing in military escalation, it means everything. Oil drops 5% in the first minute, then 8, then 12. The market is not just reacting, it is recalibrating everything it priced in over the past week, all at once. Every long position scrambling for the exit, every algorithm triggering simultaneously. And your short position, the $2 million you placed on oil falling, is returning money faster than you can process it. Your P&L, 1 million, then 2, then 3, then in a moment that will stay with you permanently, $4,127,440. The number stops climbing. Oil has found a floor. The trade is complete, and you have not moved from your chair. You do not feel what you expected to feel. You expected, if this worked, to feel something like relief or excitement, or the particular satisfaction of being right when everyone else was wrong. Instead, you feel the specific cold of a person who has just realized they're inside something much larger than they understood when they entered it. The news breaks within the hour. Not about the announcement, about the trading. Reports are already published. Suspicious volume in oil futures minutes before diplomatic announcement. The volume spikes. The timing. The contracts. 734 to 2,168 in 60 seconds. The data is public. Everyone can see it. And it looks exactly like what it looks like. The White House responds. A spokesman, speaking to a financial publication, says, "If any administration official profited from inside information, it will not be tolerated." Not a denial, not a clarification, a conditional threat. If. That one word does more to confirm the suspicion than any direct statement would. The CFTC, the Commodity Futures Trading Commission, the U.S. regulator for futures markets, declines to comment. The SEC declines to comment. The UK's Financial Conduct Authority says it is monitoring for market abuse. 3 regulators, 3 non-answers, 3 separate agencies all looking at the same volume data, and none of them saying what they see. And then Iran speaks. The parliament speaker calls the reports fake, says the United States and others are trying to manipulate markets. Oil prices bounce. Your P&L drops slightly. You don't care. The money is secondary now. What you cannot stop thinking about is the pattern, the Venezuela trade, the oil trade, the specific and identical shape of both. You lean back. You close the P&L tab. You open a blank document, and you start writing down the pattern. The Venezuela dates, the oil dates, the volume shapes, the timing windows. You stare at what you've written. You are not a financial professional. You are someone who reads charts, watches patterns, and occasionally places bets. But in the past 72 hours, you have learned more about futures markets, insider trading law, and regulatory mechanics than in any other period of your life. Let me share what you now know. First, what are oil futures? An oil futures contract is an agreement to buy or sell oil at a specific price on a future date. If you believe the price will rise, you buy, going long. If you believe it will fall, you sell short, going short. Each WTI contract represents 1,000 barrels of oil. The contracts traded on the Sunday morning in question represented, in total, approximately $170 million of exposure. The volume spike that morning was not by itself illegal. Large institutional traders move large sums regularly. Volume spikes happen. What made this particular spike suspicious, according to the published reports, was the timing. The spike occurred between 6:48 and 6:50 a.m. Eastern Time. The diplomatic announcement appeared at 6:49 a.m. Eastern Time. The trades that captured the profit were placed, according to reported data, in the window before the announcement was public. There are three explanations for what happened. Not one, three, and only one of them is illegal. Here they are. Possibility. Coincidence. The volume spike and the announcement happened to occur within the same 60-second window. The traders who placed the bets happened to be bearish on oil for fundamental reasons having nothing to do with the announcement and happened to be right. This is technically possible. Statistically, given the Venezuela precedent and the identical timing window, it is, according to multiple market analysts whose comments have been reported, extraordinarily unlikely, but possible. Possibility 2. Insider information. Someone with advanced knowledge of the diplomatic announcement, a government official, a staffer, a person with access to communications that had not yet been made public, disclosed that information to traders who acted on it. This is illegal under U.S. securities law, regardless of whether the recipient knew the information was privileged. It is called securities fraud. It carries federal criminal penalties. Possibility 3. The trades influenced the announcement. Not that traders predicted policy, but that traders with connections to decision-makers were able to place bets on an outcome they had some role in shaping. This is the most serious allegation, the hardest to prove, and the one that, if true, would represent not just market manipulation, but a corruption of the policy process itself. Regulators investigating this possibility would be looking not at trading data, but at communications, relationships, and the decision-making chain inside the relevant institutions. You are not any of these three things. You are a fourth thing, a person who saw the volume spike and followed it. You did not have inside information. You did not influence anything. You recognized a pattern and placed a bet. Whether that is legal depends on questions that are currently being considered by at least 3 regulatory bodies. You do not have a lawyer. You are thinking about getting one. One question. If you had known, with certainty, that one of the 3 possibilities was true, that someone with inside information was moving the market, would you have placed the bet? Would knowing the source have changed the decision? There is no clean answer, but think about it, because the regulators are going to ask you. It has been 1 week. No letter, no call, no knock on the door. You have checked the news 112 times. You have read every publicly available article about the investigation. You know the names of the regulatory bodies. You know what CFTC stands for. You did not know that a week ago. The $4 million is still in the account. You have not touched it. You are afraid to. If you withdraw it, does that look like you knew it was coming? If you leave it, does that look like you know you're being watched? If you close the account, does that trigger something? You don't know. You don't have a lawyer yet. You keep meaning to call one. You keep not calling. Your phone buzzes. The contact name. Mom. You stare at it. You watch it ring. You do not answer. The call ends. Voicemail. You cannot talk to her yet, not because you don't want to. because you do not know what you would say. I made $4 million on a trade that is being investigated by 3 regulatory bodies, and I don't know if I need a lawyer or a confession or just a very long silence. You cannot say that, so you say nothing. You start researching. Not for the next trade, for understanding. You read everything publicly available about the cases that have defined insider trading law. The cases where people went to prison for following patterns that looked, from the outside, like yours. The cases where people did not. The difference between them, you discover, is rarely about what the person knew. It is about what the government can prove about what the person knew. You remember the exact moment, sitting at the desk, watching the volume spike, opening the order ticket, when you understood that you were doing something that could not be undone. Not the trade itself, the decision before the trade, the moment you chose to follow the pattern without knowing where it came from. That was the first time you genuinely understood what risk means, not as a concept, as a fact about your own situation. You did not cause any of the events that allowed this trade to be profitable. You did not create the diplomatic situation. You did not move the market. You did not have access to any information that was not visible to any other person watching the same charts. And yet, you benefited from something that, if the worst version of possibility 2 is true, involved a crime. You didn't commit the crime, but you were standing in its financial shadow. Would you do it again? If you saw the same volume spike tomorrow, 2,000 contracts in 60 seconds on a Sunday morning when the market should be sleeping, knowing everything you know now, knowing what it might mean, knowing where it might lead. Be honest. You don't have a clean answer, and you're not sure a clean answer exists. 3 months later, the investigation is ongoing, according to publicly available reporting. No arrests have been made in connection with the oil trades. The focus, according to reported accounts, is on the entities that placed the original volume spike, not on the smaller traders who followed. You have not been contacted by any regulatory body. You have made a decision about the money. You consulted a financial advisor, not a lawyer, which you still probably should do, about the options. You are giving 60% of the realized profit to 3 organizations chosen for their work in financial education and economic access. Not publicly, not for credit, quietly. The money moving to places where it might do something other than sit in an account making you afraid. The 15% you kept, you are not trading with it. You are living on it, simply, while you figure out what you actually want to do with the understanding you have now. The understanding that markets are not level, that information has a price before it becomes public, that the line between legal pattern recognition and illegal trading on privileged information is real, but that the line is not always visible from where you are standing when you have to decide. You think about that Sunday morning sometimes. The volume spike, the 60 seconds, the click, the 15 minutes, the number on the screen. And you think about the other people, the ones who placed the first bets, the ones who knew before the market knew, the ones whose names do not appear in any investigation because they were careful enough to not leave the kind of trail that shows up in a published report. They are still out there. The pattern is still out there. The market never forgets how to do this. It just finds new ways to hide it. Be honest. You saw the same volume data that morning. 2,000 contracts in 60 seconds. You knew what it might mean. Would you have placed the bet? What would you have done?